One of the biggest advantages of being an OFW, we have the power. The power to grow your wealth in the country where you earn, or invest back home, our beloved Philippines. But then, that's what also makes it confusing. I was having tea with a friend, also an OFW, and she said, I save here in the UK, I send money back home, but I still don't know if I'm doing the right thing. Should I buy a condo in Manila, try Pag-ibig MP2, or just save all my money for a pension here in the UK? Well, if you feel the same way, you came to the right place. This video is for you. According to the World Bank, the Philippines is now the fastest growing economy in Southeast Asia. And the opportunities are real. But the UK offers structure, stability, and we have advanced financial tools. So where should your money go? Stick around, hit subscribe, and let's make smarter investment decisions together. My name is Adore. I'm an OFW living in the UK. And today, we're diving deep into a head-to-head bet between the UK and the Philippines. Who takes the crown? Can a £200,000 flat in the UK beat a 15 million condominium in the Philippines in terms of rental yield and property appreciation? Should you park your money in a UK cash ISA or in a high dividend Pag-ibig MP2? At the end of this video, you'll know exactly where your money works harder for you. So make sure to hit that like and subscribe button because this video can empower you to make smarter financial decisions. Let's start with rental property investment. This was an actual analysis I made when I was looking to invest for a property in the northern part of the UK in Manchester. And at the same time, a state agent in the Philippines called me to offer an exciting property development in Baguio City, also the northern part of the Philippines. So let's compare both investment opportunities apple to apple. We have a 2-bedroom flat in the UK, 2-bedroom condo in the Philippines. Both are in a nice location with no renovation required. The property value in the UK is £200,000. That's roughly 15 million pesos equivalent. If we look at the UK first, the total cost to buy the 2-bedroom flat will be around £15,000, and that includes 11,500 in taxes or stamp duties. The rest are fees such as solicitor, valuation, and mortgage fees. Looking at the interest rates, at the time of recording, interest-only buy-to-let mortgage rates are around 3.5 to 4% per annum. In terms of rental yield, it varies by location. For instance, in cities like Manchester, yields can be around 5 to 6%, while in London, they could be closer to 3 to 4%. If we look at the growth potential, historically, UK property prices have seen an average annual increase of 3 to 5%, though again, this varies by region or location. Now, if we compare that to a bedroom condo in the Philippines with a property value of 15 million, again, new build, no renovation needed, the total cost to buy is as high as 20% of the property price. This includes 12% VAT plus transfer fees, legal fees, and registration fees, which is dependent on the zonal value and fair market value, whichever is higher. So if the property is in the city center, in this case, it's a very prime location, it would cost you a lot. Looking at interest rates, at the time of recording, BDO housing loan range from 6 to 8% per annum depends on how much down payment you put in. In terms of rental yields for condominiums are approximately 5 to 7% of the property value. The property growth potential, however, urban areas in the Philippines have experienced growth rates of 6 to 8% annually over the past decade. Now, before we move to the next investment option, I would like to cover what is buy-to-let mortgage in the UK. This is a type of mortgage offered if you want to invest in a rental property only. The standard requirement is 25% deposit. This is so that you can avail of cheaper mortgage rates. With buy-to-let mortgage, you have the option to pay interest only. You're not paying the principal. So going back to the £200,000 flat example, deposit required is 25%, which is 50,000. Therefore, your mortgage is 150,000. And with interest rate of 4%, interest only, your mortgage payment will be 500 per month. The mortgage provider would typically do a valuation of the property and ensure that the property you're buying will cover around 125 to 150% of the mortgage payment. So if your mortgage payment is $500 per month, the rental property should at least generate a monthly rental income of $625 per month. And lastly, since this is an investment property, it will be subject to stamp duty taxes. This is also an example where you can use debt as leverage, meaning using debt to work in your favor as an investor. You will notice that with buy-to-let interest-only mortgage, since you are paying only the interest, your mortgage balance would remain the same, assuming you hold the property for say 20 years. But then, you would have also generated a monthly rental income, plus property appreciation. And therefore, assuming the property will appreciate with inflation at the minimum, the £200,000 value of your property would have appreciated by 180% in 20 years. So what does this tell you? If you want stability, the UK is a solid choice. If you're comfortable having someone in the Philippines manage your property, or you're looking for faster growth, the Philippines could be a great option. The best way to make a smarter financial decision, run the numbers first. Check affordability. Can you afford not only the down payment, but the cost to buy, the taxes, and the legal fees? Look at the income potential. Does it cover the cost to maintain or run the property? This means your monthly mortgage payments plus the admin expenses. And don't forget to factor in the taxes that you need to pay from the rental income. So run the numbers first before investing. The next investment option to cover, tax-free investments in both countries. In the UK, we have Cash ISA or Individual Savings Account. This allows individuals to save or invest up to $20,000 per year tax-free. The interest rates for a Cash ISA, as of April 2025, they offer up to 5% annual interest. The advantage of investing in Cash ISA is that it's flexible, which means you can withdraw or move your money around anytime. Let's compare that to Pag-ibig MP2 in the Philippines. Pag-ibig MP2 is a voluntary savings program with a minimum contribution of 500 pesos. Historical dividend rates have ranged from 6 to 7% per annum, also tax-free. The drawback of Pag-ibig MP2, your money is locked for 5 years. But my verdict, for passive tax-free income, it's pretty obvious that Pag-ibig MP2 wins with higher returns. The next investment option we compare, stocks and ETF investing. Let's compare the platform fees, the access to the global versus local markets. In the UK, there are well-established platforms like Trading212 and Invest Engine, and these platforms charge no fee for stock market investing. The great thing about living in the UK is that you have access to both UK and international markets. Also, you have the time zone advantage. You can invest before Asia closes, during the UK and European hours, and when the US market opens. With UK being a global financial hub, there are a wide range of stocks and ETFs, including those tracking the FTSE 100, S&P 500, and a number of global indices to choose from. If we compare that to the Philippines, you have local brokers such as Call Financial. They charge commission fees of around 0.25% per transaction if you trade in stocks. But with Call Financial, you can invest in blue chip stocks like Ayala, Jollibee, Meralco, PLDT, San Miguel, to name a few, or several. It's primarily limited to the Philippine Stock Exchange, with some brokers offering access to international markets. But I'm not so familiar with them, so if you know good platforms to invest in international markets in the Philippines, please comment below. Also in the Philippines, if you want to invest in global ETFs or exchange-traded funds, you have feeder funds available in your local banks. The platform fee is usually higher. So my verdict, if you want global exposure, UK markets offer better diversification. But in the Philippines, local focus investing can also be a solid option. Next, we look at pension for retirement. In the UK, we have state pension. This requires a minimum of 10 qualifying years of national insurance contributions. And to qualify for a full rate pension in the UK, you need to have contributed 35 years in national insurance. By the way, if you work for the NHS, the pension scheme is different, which I won't cover in this video. The other option in the UK is you can also set up your own SIPP or self-invested personal pension plan. This is a private pension plan allowing individuals to manage their own pension investments. The total annual contribution limit for pension in the UK is £60,000, and you have also a tax advantage, which means you can claim tax relief from HMRC or from the government. If we compare that to the Philippines, the SSS or the Social Security System is available for OFWs. There's also a new program called PERA, but it's not very popular. I'm not very familiar with them. The monthly contribution for SSS is 35,000 pesos, which is around £500 per month only. But with SSS, you are entitled to some benefits like salary and disability loans. So what is the verdict? For retirement security, I think UK has more structured options. But if you're looking for a pension with flexible benefits, SSS can also be practical. This also depends whether you want to retire in the Philippines or in the UK, or if you want to retire in both, then you have both options to invest. Again, that's an OFW advantage. Not a lot of people have that. And lastly, let's compare local cooperative investments. This is my favorite. In the UK, cooperatives are not very popular. There are member-owned financial cooperatives offering savings and loans and some membership discounts on products. The dividend rates vary but are generally modest. It's around 1 to 5%, which is very similar to putting your money in an ISA account. In the Philippines, however, cooperatives, I call them the hidden gem of the Philippines when it comes to investing. They offer savings, loans, share capital, and other membership benefits. In terms of patronage, refunds, and dividends on share capital, this can be as high as 10 to 11% annually, depending of course on the cooperative's performance. So my verdict, we have an obvious winner on this one. Your local co-op in the Philippines takes the crown. So let's do a recap. For real estate investing, if you're looking for growth potential, Philippines is an option, but for stability and accessibility, UK is your other option. You might be also wondering which investment option I went for. Is it the Manchester flat or the condo in Baguio? After running the numbers, UK was a cheaper option, but considering the tax implications, the amount of tax I have to pay from the potential rental income, I realized both options were not in line with my personal investment goals. Now, let's move on to tax-free investments. It's pretty obvious that Pag-ibig MP2 takes the crown due to higher returns. For stocks and ETF investments, both countries are great, with UK having a big advantage due to access to global market and mature global financial center. For pensions, this depends on where you want to retire and how much you're spending in each country when you retire. Would you live in the Philippines during winter months in the UK or stay in the UK during the wet season in the Philippines? It's a good problem to have, so I say both options are applicable. And for local cooperatives, Philippines is the obvious winner. There you have it. Let me know what options you are going for, or if you know other investment opportunities for OFWs, please share in the comments below. For more contents like this, hit the subscribe button so you won't miss brand new videos coming up.